Tuesday, the 16th of August 2011, still within this ascending triangle and still waiting for either the confirmation break above or the move lower. And today we're mainly going to be focusing within the volatility. This is a chart that I've been showing for a little while now. We'll go over some longer term volatility within gold, silver, as well as the Dow Jones Indices. And I was stating roughly around here that the volatility should be picking up and way wrong. And I guess I could still be right, but it didn't find support within this a little average in here. You got this downtrend line. Things right now are slowing down, and this is short-term volatility. Let's move this on to the long term, and we'll start within the Dow Jones Industrials. And the calculations for this Dow volatility chart is the following. You take the highest period of the last 200 days, and you can use any days that you wish. I chose 200. You could use 100, you could use 500. It's up to you. And I take the 200-day low, and I divide it again by the low. As long as all the numbers are the same, then you will find out how volatile markets have been over a significant period of time. Therefore, going back to 1930, really even 1929 for that matter, the Dow Jones Industrials faced a large volatility as the move got to about 225% from its lowest and highest level over that of a 200-day period. In 1987, we had what I now call the stock market correction or the great correction. I don't know, because people talk about 87 being that of a major crash, and when you look at the charts, when you held above the rising 200-day moving average or all the long-term moving average, it really wasn't much of a crash. However, the volatility was a little bit higher, or it was at that point the second highest volatility going back to the 1930s crash. Well, in 2008, 2009, we exceeded the 1987 levels, but did not exceed the 1930s. I'm not going to state that this level is going to be taken out. Rather, the selling that occurred was less, and it has happened before, of having massive volatility. This data shows that it's not so volatile right now. Each period represents 200 days. Each candle's 200 days. And you would think, well, we've seen the Dow Jones go from about 12,800 down to 10,400. Isn't that like really volatile? Well, one, this is long-term charts. And what was happening is when you have a chart that looks like this, higher highs and higher lows, and the market does any type of fashion like this. Now, if this is 200 days ago, and this is where we are now, if the markets keep going sideways, then what's going to happen is we're going to start to see that the volatility will reduce because the 200-day low will start to increase with time. And that was what was happening here. So the market kept going lower. So as these numbers started to increase, they kind of met down towards here, thus keeping the volatility the same rather than going back down to this previous support level at roughly at about 15%. What I'm going to do with this chart, gold and silver, I got this for all three, is the original large volatility and then reduce the scaling just a little bit. And within this, I don't think there's really much to point out other than there was a major level of support in here. And then from the time of, say, what looks to be around 1939 to roughly right in here, 1977, it traded within a 12% up to about 40% range where the market never got volatile whatsoever. Generally speaking, high volatility happens on turning points as well as within down markets. When the markets are in the regular pattern of higher highs and higher lows, like we've seen in the 1990s with the Dow, then the volatility won't be so large. Now let's switch this up to gold. And with gold and even silver, we're going to be using a line chart. Same thing here, 200 days. We're looking at the highest point over 200 days and the lowest point over 200 days and dividing it by the lowest point again. Okay, well, we have this downtrend line in here. Whatever shape or pattern you want to, or whatever name you want to give that pattern, what it's showing us is that the volatility from 2006 is nowhere near where it is today. Also, the volatility in the past, we had the move go from 100% over a 200-day period, meaning the markets doubled in 200 days. And then the markets did better than triple over a 200-day period from bottom to top. Okay, so we know for sure within this data that we've been more volatile than we are now. Now, was there any news back here to support this high volatility? Well, in 1971, it was Nixon that stated, you know what, let's get off of this gold standard here and yeah, we'll see how this all plays out, which created the volatility, and boom. Now, today, do we have any news within people waking up to how debt's created, debt collapse, and all that kind of thing? And you may even think that it's higher than it was back then as far as how big the news should reflect the charts. Let's move on to silver. Actually, before we do, I want to reduce the scaling of this first to see it better. All right, now we can see the line movements just a little bit better. Then we'll move on to silver. Do the exact same thing, exact same length of charts, and it would be very, very similar to say the least. But the volatility seen in 2006 was the greatest volatility not seen since 1983. On to silver now. And right now we can see this pattern of higher highs developing, and currently this volatility is the highest it's been since here. In fact, this is the fifth time that it has managed to come up near the 200% mark. The first time came right after the Bretton Woods announcement by Nixon. That got some volatility. And then, as some people would label it, the Hunt brothers cornering the market. I have a different perspective within that, but a lot of the analogy is still very similar. And then twice it tried to keep on the movements, or it's the bounce from high volatility. When you start to see you have a big bounce followed by a lower bounce and it's back here, that means the damage probably is over for the time being. But then again, that would be very common. Now again, we can see here how the volatility has managed for this to go up and down. Well, why is that? Well, when silver reached $50 per ounce in the time frame of the end of April, that meant the high was $50 and the low on this was about 18 or so, 17, 18, anywhere in that area. Well, now some time has moved on and the lowest point's now 24 or 25, and well, that's a big reason why it keeps going lower, because enough time has come into place to bring this lower. And that's why a lot of them have done that even in the past as well, because you have your big move, then you do nothing for a while, or you at least don't maintain the same or close to the same rate as before, then that's going to happen every time. Now let's shorten this out again. And we can see things just a little bit better. Maybe we could draw a trend line in here as something like that, as the trend for where volatility happens to be played. It's obviously going higher, but this is to be expected when you have reasons for this to be the case. All the news of how money is created, or I shouldn't say money, I should say fiat currency. For to know how money's created, you'd have to know how gold and silver is actually mined. And put into Boolean form. Okay, so that's the volatility for today, and I'm going to finish this off with a quick market update on the short-term time frame. And what we're looking here is at the 6 hour chart, which has a 5 day front weighted moving average. And I've been stating on here for a month that it is within a test. I said down here that it really needs to break below 37 and for me to say, hey, you failed this test. And it came close. It came very close. The pressure was on, but the student got the pencil motivated and well, is looking like it might want to pass now, and the test isn't even close yet to being over. I need to see really a decent size push up from this level, and for that matter, after it has a push, show some sort of consolidation. The only way that a push would be in itself big enough for me is if it were to at least come back to its previous highs, and then it does look to me then that we will be reversing the trend. And that would be an area. What I'd be looking for is some sort of breakout that can get the market up to some highs not seen in a while. Let this moving average start to continue to rise, and either with a correction through price or time to meet up with this and then really lift higher. Now we're already at a point now where the moving average is in a rising situation, which is in itself strong. We have these bands here that are lowering. This tells us the volatility is lower, indecision is within the market. That is a temporary thing. Okay, thank you for tuning in today and have yourself a great day. Bye bye.